Okay, so as I say all the time, understanding the macro, the Federal Reserve policies, and the government policies are the most important aspect to consider when investing, especially after the global financial crisis era. Looking at the market in recent weeks, I think it was a very good representation of why such statement is true. Okay, so I think it's a good timing for us to do a recap on where we are with the market. So let's get to it. Now, I want to deep dive into the key data that came out in the past 2 weeks. These are some of the key data that came out. S&P Global Manufacturing PMI for March was at 49.8 versus expectation of 51.9 and 52.7 of the previous month. Now, as you may all remember, I've always been saying a number below 50 is considered a sign of weakening of manufacturing activities. So basically, the data showed that the economic activities are weakening versus what we expected in the previous month. Consumer confidence was at 92.9, which was lower versus the expected 94.2, and also lower versus the previous month of 100.1. So in accordance with the PMI data, consumers' consumption activities also showed a weakening trend. Also, ISM manufacturing PMI also fell to 49.0, which was lower than the expectation of 49.5, and also lower than the previous month of 50.3. The Federal Reserve balance sheet was at 6.74 trillion, which was slightly lower than the 6.76 trillion of the last month. Okay, so if we look at all those data, basically the message which the data is telling us is that the manufacturing activities are weakening and consumers are also feeling the economy is weakening, so losing confidence in spending. At the same time, the Fed balance sheet is still contracting, though at a slower pace, which is slowly draining the liquidity out of the market. Now, the Federal Reserve balance sheet aside, how do you think we can interpret the data? Well, some of us might be thinking that, okay, there's a pretty famous notion which says bad is good, and given the data is bad, maybe it'll be good for the market. Well, let's try to see if that's the case. Now, after the Federal Reserve started adopting the quantitative easing and started manipulating the interest rate frequently, the bad is good notion became quite popular, meaning that if the data is bad, the market goes up. Now, this notion works because the Federal Reserve's role is to prevent unemployment from going up. Generally, if the economy is bad, the Federal Reserve gets extremely worried about the unemployment rate going up. So they would either decrease the interest rate or increase its balance sheet to provide more liquidity into the market. Okay, so to assess the situation, basically the chains of reactions goes like this. Economy shows signs of weakening, for example, bad ISM, PMI, consumer confidence data, which leads to the Federal Reserve being worried about the unemployment going up, which leads to the Federal Reserve either lowering the interest rate or increasing its balance sheet, which leads to the market going up. I explained why the market goes up when the interest rate gets lower and when the Federal Reserve balance sheet increases in my investment strategy video. So if you haven't checked it out, please check it out. Okay, so this is simple. Now, if unemployment rate is actually increasing, the Fed may be able to take such actions. However, the US unemployment rate, which came out this week, showed a 4.1%, which didn't change from the previous month, and still at a very low level. So the Federal Reserve does not have any ground to decrease the interest rate or increase the Federal Reserve balance sheet. Also, there's one other thing which the Federal Reserve extremely cares about, and that is the inflation data. Now, the data which came out related to inflation still remained a problem. Core PCE price was at 2.6% versus 2.7% expectation, but a lot higher than 2.2% of last month. Also, more importantly, Michigan one-year inflation expectation was at 5.0% versus 4.9% expectation, and a lot higher than 4.3% of last month. Basically, Michigan inflation expectation is a representative data showing how the consumers are viewing the inflation to span out in the next 12 months. Now, as I said all the time, the Federal Reserve's inflation target is at 2%. Decreasing the inflation from 2.8%, which was the figure from February, to 2.0% is extremely, and I repeat, it is extremely hard. Now, having that said, if the consumer expectation on inflation is at 4.3%, this is a disaster for the Federal Reserve. Now, this is partly the reason why the market went down so much in the previous weeks. Now, with that, if we try to reassess the above trade reaction, taking into account of the unemployment rate and inflation data, it comes down to this. Economy shows signs of weakening, for example, bad ISM, PMI, and consumer confidence data. The Federal Reserve will look at the unemployment data. The Federal Reserve sees low unemployment data, and the Fed is stuck. Also, economy shows signs of weakening, for example, bad ISM, PMI, consumer confidence. The Federal Reserve will look at the inflation data. The Federal Reserve sees high inflation data, and the Fed is stuck. So either way, the Federal Reserve is stuck and cannot do anything. Also, with the potential tariff being implemented to the whole world, which we'll get to later, they have to be even more wary of the inflation data. So they have absolutely no grounds to decrease the interest rate. Now, the data which came out in the past week was a loud and clear announcement to the whole world that the Federal Reserve is stuck, which was disastrous to the market. Okay, so basically what's happening is this. Basically, the economy is weakening, but the inflation is still high. Now, based on the data, we're basically entering a new realm of stagflationary economy. Just about a couple of months ago, or even just a month ago, the manufacturing data and ISM data were still strong, meaning that the economy was still strong, while we had inflation. Now, the scenario can be called an inflationary environment, given the strong economy and inflation coupled together, which is not ideal, but something we can live with if we don't pay too much attention to the stock market. I mean, generally, as long as the Federal Reserve keeps the interest rate high and continues to decrease the balance sheet, inflation will cool down at some point, and as long as the economy is strong, a country will be okay. Now, the problem with a stagflationary economy is that if the Federal Reserve keeps the interest rate high and continues to decrease the balance sheet, it'll hurt the weakening economy even more. Now, the inflation is also underway, so basically what this means is people may be losing jobs and suffering because the economy is doing bad, and people will suffer even more because the Federal Reserve has to keep the interest rate high and drain the liquidity from the market. And people will suffer yet even more because the prices are rising, which decreases their purchasing power. So basically, it's a triple whammy situation for everyone, which is almost impossible to fix. Now, with this situation, the US is facing a lot of problems. Remember I told you that the components of a country's GDP is C, G, I, and X? C is consumer spending, G is government spending, I is corporate investments, and X is net exports. Now, with the stagflation situation, obviously the C, which is consumer spending, will be gradually weakened. I, the corporate spending, will also be impacted as corporates will make less money if consumers don't spend. And X, which is net exports, will also go down because the dollar is currently strong. Now, a lot of you ask me why the dollar is strong, and a dollar is generally considered strong if the dollar index is above 100. Also, with the stagflation, the US have no ground to decrease the interest rate, which means the US will most likely have a high interest rate in the near term as well, which may further strengthen the dollar. Basically, what this means is that out of the 4 components, 3 key components may face challenges, which may bring the US GDP down even further. Okay, now this is where Donald Trump steps in. Now, similar to the Federal Reserve, Donald Trump and his administration is kind of hitting a roadblock where they only have limited options to consider. By the way, this is just my personal thought, but I can kind of see why Trump is blaming Biden so much. The current situation is really incurred from the former administration's excessive spendings to keep the economy afloat during COVID, which I'm not sure was entirely necessary. I mean, it was necessary, but looking at how much people's savings in the bank account increased during the past few years, there were quite a bit of surplus which was provided to the people, which I believe was an action to get re-elected in the next presidential election. Okay, now, that aside, as a measure to all of this happening, Donald Trump is going full force with the tariffs. On April 2nd, the so to speak, the Liberation Day, Trump announced 10% tariffs on all imports into the United States, and even higher tariffs on goods from around 60 countries, including China and European Union, which will be imposed with 34% and 20% tariffs. The baseline 10% tariff will go into effect on Saturday, and any higher tariff will go into effect on April 9th. Also, the 25% tariff on goods from Mexico and Canada, which were formerly imposed will remain in place until certain issues around fentanyl and illegal immigration have been resolved. Okay, now these are all over the news, and the factual stuff can be read by anyone by themselves, so I won't go into further details. But let us focus on what is really important, the implications and predictions. Okay, in order to do that, let's go over some quotes by Donald Trump. Number 1, the tariffs are going to give us growth. Number 2, jobs and factories will come roaring back into our country, and you see it happening already. Number 3, this is not full reciprocal, this is kind reciprocal. Number 4, for years, hardworking American citizens were forced to sit on the sidelines as other nations got rich and powerful, but now it's our turn to prosper. Number 5, I say terminate your own tariff, drop your barriers, don't manipulate your currencies. Okay, in addition to what Trump said, JP Morgan's chief economist stated that the Liberation Day announcement could boost PCE prices by 1 to 1.5 percentage point this year, which would most likely be realized in the middle of the year. So basically, from the current inflation of somewhere between 2.5 and 3%, inflation can even increase to around 3.5 to 4.5% level, which will be even more catastrophic to not only the US but also to the world. However, in this situation, it all comes down to which outweighs the other. For example, if the economic outlook is a lot worse and serious than the inflation, the Federal Reserve will have to cut the rates. If it is the other way around, the Fed will not be able to cut the rate. Strangely, the economists seems to be predicting that the economic downturn will be more severe, and therefore the Federal Reserve will have to cut the rate starting from June. I'm not entirely sure whether that is true, but we'll have to see how it spans out. Okay, so with all that, why do you think Trump is taking such radical actions, and what could be some of the predictions that stems out of it? Remember I told you that the economy is composed of C, G, I, and X, and due to the stagflationary environment, 3 components out of the 4 are getting destroyed. Basically, my interpretation is that Trump is trying to save the country's GDP by implementing these tariffs. If you think carefully about the tariffs, basically the tariffs are implemented towards the goods which are being imported. Now, what this means is that if a foreign corporate comes into the US and builds factories in the US and starts producing in the US, those goods will not be impacted by the tariffs. Okay, so basically what this means is that the I component, which is corporate investment, will be somewhat saved with this measure. Also, if foreign corporates come into the US and starts manufacturing, they have to hire US workers. Now, if more US workers are getting hired and get paid from the foreign companies, they'll get more income, and the C component, which is consumer spending, will also be saved to some extent. Now, my another prediction is that leveraging the tariffs, Trump will threaten other countries to strengthen their currencies. Now, some of you may know about the Plaza Accord, which happened in 1985. Basically, back then, the US exports were getting destroyed because of other countries' currencies, including French franc, German mark, Japanese yen, and British pound, being so weak against the US dollar. Now, through this meeting, the other countries agreed to strengthen their currencies against the US dollar. And what were the consequences? Japan, which was the biggest threat to the US, ended up experiencing the most ridiculous bubble of all time and crashed altogether, going into 20 years of low growth phase. Now, I believe this is what Trump wants. He wants to get all the countries to come in front of him and agree to a certain currency adjustment, which will benefit the US and harm the economy of the other countries. After all, I'm more than certain that Donald Trump is concerned about the US and the US dollar losing its position in the international market due to the disruption of other countries led by China, and he wants to fix everything in one go. Now, the side effects of doing so will be obvious. Donald Trump will have to embrace his popularity going down, not only in the international markets, but also in the domestic markets as well, because the stock market and other capital markets will face huge uncertainties due to all these radical interventions. But my view is that Donald Trump has more important things to flush out at the current moment than worrying about his short-term popularity or short-term movement of the stock market. Okay guys, so this wraps up what has been happening in the market in recent weeks. A lot of uncertainties are ahead of us, and as I said all the time, we're still in an illiquid market environment. Also, even if the Federal Reserve decides to decrease the interest rate from June, that doesn't mean the market is going to be liquid. It would just be a temporary measure to defend the economy against it going down even further from here. So it's not a healthy decrease of the interest rate, so we need to take that into account. Let's all be careful with our actions and try our best to avoid losing money for the time being. Thank you, and I'll be back with more videos very soon.